are considered the same. If business make loss, it means partners make loss. Unless you specifically establish a limited liability company. Limited liability company or limited partners company. So generally, partnership is personally liable, but if partnership is established as limited, if you see that, okay, Jamal and Friends partnership, and in the bracket you write it down LTD limited, which means if Jamal and Friends make the loss, then loss not is going to be transferred to Jamal and Friends property. You can only sell the business and that's it, but loss is not going to be transferred, not going to be fulfilled through Jamal and Friends personal properties. Limited liability, as its name included limited liability, so it means members. We call the owners members in this case, so they are not liable. Similarly, corporation, the property of corporation is that they are not liable. So only the amount they have invested, the value of the share they have purchased, only that will be lost. That's it. Right? If I purchase the shares of Nestle, if Nestle is bankrupted, I may lose only the amount of the shares that I purchased. That's it. Not my computer is going to be sold, not my car, my fancy clothing, my house, whatsoever is not going to be sold, right? So everything I have just discussed here, just pause the video and read it by yourself. Like a limited liability partnership, lessen the risk to partners. Because if you wrote down the word partnership limited, then your personal belongings are not going to be included to fulfill the loss. Limited liability companies, right? Just pause the video and read it by yourself. We just talked about all this stuff. Corporations. Now, we talk about the forms of the corporation, form of the business, and corporation is the fourth form. So if we have proprietorship, we have partnership, we have limited liability company, then why there's a need of corporation? See? Why there is a need of corporation? Members can be 1, can be 100, can be 50, can be 200, 2000. So if we have proprietorship, we have partnership, and we have limited liability company, then why we need corporation? What is the benefit? Not liable, not liable. Why we need corporation? The answer is ability to raise funds. Limited liability company maybe can only raise up to $1 billion, $2 billion. But if corporation needs money, they can even ask for $100 billion, $500 billion loan. Plus, corporation can also expand to overseas multinational companies. Right? So it is easy for the corporation to raise large sum of capital from issuance of stock. Right? But it's not that easy because it has strict laws governed by the government or Security and Exchange Commissions. In this case, in case of corporation, business and owners, they are not considered the same. Why? Because those who owns the stock of the company, those who are the owners, they are not running the company. They are just sitting in their houses, watching film, watching sports. But who are running the company? Managers. So in that case, if business make the profit, that doesn't mean that doesn't mean that the owners also make the profit. In the eyes of law, the government will say that if the business has a separate entity, if the business make the profit, we will tax it. What's going on here? Why I cannot write? Guys, can you hear me?
Yes.
Yeah.
Yes.
Yes. Yep.
Rules are just jammed. I cannot write, I cannot move forward. I don't know what happened. Okay, let me just explain this concept. Why I cannot write? That's amazing. Oh, started to work. Okay. Okay, we were saying in the eyes of law, it states that business and the owners, stockholders are not the same. So if business make a profit, we will tax it. And when business remit the profit to its owners in the form of dividend, dividend means that income that the business made and distributed to its owners. The government also include this as your income and tax it. So in this case, there is a double taxation, right? So this is what we mean by double taxation. First of all, corporation pay the income tax, and then shareholders also pay the income tax, right? So do the owner have the power? Yes, because we know that the owners are not managing the company, right? So then owners are only eligible to receive the dividend and nothing else? No, owners have some right. Owners elect the board of directors who run the company. They delegate the power to make decisions, to expand the business on a specific board, and they set the policy. The board of directors, they set the policy and appoint officers, managers, general managers, senior managers, financial managers, CFO, CEO, CIO, investment officers, chief operation officers, right? Marketing officers. So they appoint that, and the rest of the chain it's started. Now, the second learning objective is explain and apply underlying accounting concepts, assumption, and principles. So we are talking about principles of accounting. So let's just talk about the concept and assumption. First of all, the principle that we follow, or you can say that the accounting laws that standardize the presentation of data in the form of reports or something so that everybody understands, they are two. Number one, GAAP, which is generally accepted accounting principles. So it's a law of the accounting system, accounting framework, that how you are going to write the information, which comes first, which comes the next, which comes next, and what is written at the end. So this is a specific format that you need to follow so that everything is standardized. So even if you are in Japan, even if you are in North America, you can easily understand the financial statements of both, countries as well. Okay, if you have a business in Japan, if you have a business in North America, both statements come to you. You can easily compare. You can easily understand that. And the other one is FASB, which is Financial Accounting Standard Board, which also sorry, that is okay, that is next one. So this is the board that makes the gap. And do we have another one? Okay, yes, gap. So financial accounting standards, they make the principles, they issue gap principles for you. And there is also IFRS, International Financial Reporting Standard. There are two authorities. So this is number one, this is number two. FASB, which basically makes this gap, and the second one is IFRS, which also makes the accounting standard. The difference is a little bit, it's a minor, not major difference, mostly minor differences. And normally every country has its own regulations. So every country is using, because this book is US centric. So the gap, overall major principles are the same, but if it would be applied in Germany, so it would be called gap Germany, China, gap China. So they have different twisted version of their own as well. So also, if you are not using gap, then you can use IFRS as well. But the difference is a little bit minor. Only difference is how to make the cash flow statements. We will talk about in our coming slides. Don't worry about that. So now, financial reporting standards. So why we apply or why we follow the law? First of all, let me set aside those controls so that I can read. Yes, here. So to provide financial information about the reporting entity, because financial information is only available to outsiders. Outsiders are lenders, creditors, investors, government agencies, investors, individuals, right? So when you provide the information, it should be relevant for them as well. Plus faithful representation. So if I write that, okay, my profit is $100 million, so that doesn't mean that it is a fake figure, right? Because if I want to invest in this company, if, for example, if I want to buy Apple company share, I'm not going to the Apple company inside and seeing the structure and all the stuff, okay, and then I see that, okay, this makes sense because they are a big company, good company, and so they are making huge profit, so I should invest them. No, you just seeing the paper, the financial statement, and then you decide, okay, whether I should invest or not. So you are believing the papers, the written figures, and these figures are written by humans, printed by computers, right? So now the basic, fundamental qualitative characteristics is that the information should be relevant and faithful. It doesn't mean that, okay,